When it comes to money, the only skill most people know is to work hard. Robert Kiyosaki. Money, money, money. Hello, welcome to Dragon Financial. I'm your host, Brad. Have you ever wished for more money? Or maybe just to understand finance? Here at Dragon Financial, we do things a little bit differently. Every episode will take us on a planned series of learning more about money. This is a journey that will take us through the history of money and teach you what you should have learned in high school. Our team has prepared a multi part series to teach you the basics of money and finance. So if you want to master money and finance, subscribe to the Dragon below to take this journey with me. After we've learned the basics of money, we'll dive into the stock market, and we have several more series coming your way. We can't promise to take you from zero to hero, but we'll try our best. So let's dive in. Today, we'll be looking at one of your most important financial numbers, the FICO credit score. FICO actually is the name of the company that created the credit score, the Fair Isaac Corporation. So we will just refer to it as your credit score. All kinds of companies use this number. It is used for loans such as student, auto, credit cards, and mortgages. It is also used by insurance companies, potential landlords, employers, utility companies, and the government. Because it is used so often and by so many different companies, it is considered one of your most important financial numbers. So let's dive in and see how it works. A credit score tells a business how likely you are to pay your debts. Companies use it to help determine your interest rate, credit limit, and even your approval for the loan or rental. This number ranges from 300 to 850 points. Having a score greater than 800 is considered excellent. A score between 740 and 799 is very good, and a score of 670 to 739 is good. Below 670, you may be able to get credit still, but you will be considered a high-risk client. There are three major players in calculating your credit score: TransUnion, Experian, and Equifax. They all use a slightly different calculation for your score, so it can fluctuate a little depending on what company calculates your score. But they all use the same 5 factors to determine your credit score: payment history, 35%; credit utilization, 30%; credit length history, 15%; credit inquiries, 10%; credit types, 10%. The biggest and most important category in calculating your score is payment history at 35% of your score. Payment history looks at your on-time payments for your loans and credit, where even missing one payment can negatively affect this portion of your score. One way to reduce the effect of a missed payment is to have a couple of different credit cards. That way, if you miss a payment on one card, you still have several cards with perfect payments, meaning the missed payment will have less effect on your score. Having a good payment history shows companies that you are reliable and can repay your credit. Next biggest category is credit utilization, or how much of your credit limit you are using. This accounts for 30% of your credit score. And in general, you want to only use around 30% of this limit. For example, if your credit limit is $1,000, you only want to use $300 on the card in a month. This part of your score is also helped by having multiple cards, so that your total credit limit with all the cards added together is higher. That way, if you use over 30% of your limit on one card, it has less effect on your score. On the contrary, high utilization of your credit limits shows companies that you are at high risk of defaulting on your credit. If you like money, hit the like button. The next part of your credit score is the credit length history, or age, of all your credit. This accounts for 15% of your credit score. In general, for this part of your score, the longer or older is better. Therefore, contrary to popular belief, canceling your old credit cards can actually negatively impact your credit score. One should also be aware that opening several new credit cards or loans will lower your credit score for a period of time because it will lower your credit length history. Next part of your credit score is your credit inquiries, or how many times companies have looked at your credit score. This accounts for 10% of your score. Companies looking 1 or 2 times usually doesn't affect your score too much. But If you have a lot of inquiries on your score, it could show that you are constantly seeking credit, which could negatively impact your score. Final category is credit types, which accounts for another 10% of your score. Companies are looking for people that have used several different types of credit. However, it is not generally recommended to open a new type of credit just to raise this part of your score, because it will lower your credit in other categories. So only open new types of credit when you legitimately need to use them. Now that we know about what makes up our credit score, how can we make it better? One of the best ways to build your credit score is by getting a credit card as young as possible. Paying off your card in full every month, having a credit card for a long time, and never missing a payment. Additionally, if you get a mortgage, student loan, or car loan, you want to make your payments consistently on time. Interested to know more about loans? We'll be taking a look at loans in the next lesson. So, how can I see my credit score? Well, it is actually quite easy. The government has required that you can get one free credit report yearly at annualcreditreport.com. It is important to use the correct website because there are many other sites offering free credit reports. Annualcreditreport.com is the official site mandated by the government to give you a free credit report. This report will allow you to review your score and check for any mistakes. In addition, several credit cards will give you access to your credit score monthly, as well as offer credit monitoring services. If you apply for a mortgage or car loan, you can usually ask the bank what your score is. Another way to see your credit score is a service I personally use called Mint. With Mint, you can safely connect all your accounts, and it will show and monitor all of your transactions across all of your accounts, as well as remind you of your payment due dates and monitor your credit score, all for free. I will leave a link in the description if you are interested in signing up. Here is a quick review of the topics we learned today: credit score ratings, 5 categories that determine your score, payment history, credit utilization, credit length history, credit inquiries, credit types, how to build your credit, how to see your credit score. I will leave timestamps in the description below so you can quickly review any of these topics. Remember, this is not financial advice, and I am not a licensed financial advisor. These are my personal thoughts and opinions. Also, I am not being sponsored or an affiliate for annualcreditreport.com, but I have included an affiliate link to Mint, a service I personally use, and you may be eligible for a reward if you join. The link is in the description below so that you can apply for their service. I hope you enjoyed our journey today as we explored the credit score. Join me next time as we look at loans in our series on money, what they didn't teach you in high school.